Welcome to the Market Enthusiast podcast, where Good Life's Noah Brooks, Chief Market Strategist, and Chris Needs, Senior Research Analyst, break down today's topics, covering their impact on the economy and personal finance in a fun, easy-to-understand way for investors of all levels.
Hey, welcome back to another episode of the Market Enthusiast. I'm Noah Brooks. Obviously, Chris Needs with me today. Well, I'm going to do my best impression of Ron Burgundy, the anchorman. Well, that escalated quickly. It only took 16 days to go from all-time highs to technical correction down more than 10%.
Sixth fastest in history since 1950.
Sixth fastest.
Yep.
Yeah, that's kind of nutty. There's a lot of things leading up to that. But 16 days to go 10%. That is pretty quick. There's obviously 5 faster, but man, and it felt it too. I think everybody was sensing it. It's not letting up today either. We're going to be down again today.
We randomly popped up. What was it? Mid to late February to another all-time high, and then slammed right back down.
Yeah, February 19th, all-time high, 6144 on the S&P 500. Everything felt amazing.
Until it didn't.
Until it didn't. Well, that's how it works in the markets, everybody. I mean, everybody that's been around a little bit knows that that's the case. To your point, 6 fastest, that means there's been 5 before that. I think you have some stats on drawdowns in general, right, that we're going to talk about today?
Yeah, so 10% drawdowns occur on average every 1.6 years. So, if you do that math and work it back, 95% of years have a 10% drawdown. Super common.
We didn't have one last year.
Right.
Last year, 2024, the largest drawdown was 8.7%.
Correct. Yep.
And at the time
we were due.
We were due. At the time with that 8.7, it felt a little bit rough, but in the end we had a great year.
Yeah. So talking about it was the 6th fastest, 10% correction. Looking at the other scenarios where that happened. So I looked at the top 7. So we had 6 pieces excluding this one. And after 12 months, we only had 2 instances that were negative. So, you can look at it as, maybe it's a buying opportunity. There is certainly times in history where buy the dip has worked. This time may be different. We're dealing with a few other things here. But historically, it's not the worst time to buy.
I think buy the dip works most of the time. I mean, anecdotally, you can say buy the dip works all the time. And it doesn't necessarily work for an individual stock, right? Because those individual stocks, they can go bankrupt. A great example of one that actually didn't go bankrupt, but buy the dip, it didn't work, still hasn't worked, is a company like Citibank. After the global financial crisis, they were essentially a $50 stock. They did a 10-for-1 reverse stock split. I think today they're like a $67 stock, which makes it $6.70. So it never really regained after 2009.
Yeah, that was something structural where they never recovered, and the stock price still hasn't gotten back.
Yeah, but for the market,
it's done great.
I mean, buy the dip works. There is no question about it that buy the dip works. I've been telling clients and advisors, try to think of it as more of an opportunistic scenario. Obviously, buy the dip works, but the market cannot continue to go up indefinitely without any types of pullbacks.
Mm-hmm.
These types of 10% drawdowns, they're healthy for the market. And even if we go further, that doesn't mean that it's not healthy. Right? Yeah. It doesn't feel good, but it doesn't mean it's not healthy. It's kind of like going to the doctor, right?
Gotta take your medicine sometimes.
Gotta take your medicine sometimes. Absolutely.
Just want to clear up. So it said how 2 of those instances were negative, and that negative is below all-time highs. So out of those 7 instances of quick corrections, only 1 of them was negative from the 10% down. And the average return 12 months later, 18%. So
I think everybody's head is like, they know, most investors know that the time to make money is when the market goes down. Not everybody, but a lot of people know, certainly most financial advisors know that. It's hard to do it in the moment because of emotions. And, right now is a perfect example of that. When you look at the reasons why the market is going down, I think most people emotionally, and some of this has to do with where you lie politically, but most people emotionally will point to the tariff situation. But there's more than just tariffs, right? There's the Fed rate cut uncertainty. There's moderately slowing disinflation. There's slightly weaker labor data. And then there's a general, maybe pessimistic viewpoint on what's going to happen later in this year because of some of the layoffs, right? But you could make a case for a lot of that, with the exception of the tariffs, at any point in history throughout the United States. And the same thing happens. We go through it and we come back stronger. Sometimes it takes a little bit longer. Sometimes it only takes a few weeks, a few months. Sometimes it takes a few years. But I would suggest to most people in this scenario, pull your emotions out of it and think about it as a portfolio manager. Look at the stocks that you wanted to own for the last few years that maybe you didn't have the opportunity to purchase, and now you do. And it brings up a great point. I'm going to say you coined it. What, the lag 7 last week, right? They have been lagging. Year to date, most of them are down.
Aren't all of them down now?
Well, they're all down. They're all off their highs. I don't know where they all are.
Year to date, I thought Meta was the last of the Mohicans, as they say, and they're negative now too.
Down 3.7% year to date. Google's down 22% off its highs. Amazon down over 20%. Apple kind of beating the rest of the bunch at down 17.5%. Facebook, Meta down 21.5%. Nvidia down 21.5%. Microsoft is the darling, down 15%, and Tesla down 52% from its all-time high. That brings the S&P 500 down as of today about 9% from its all-time high. We were in correction territory last Wednesday. I think it reached down 10.1%, and we had a gangbusters Thursday and Friday, and kind of pulled this up a little bit, made everybody smile. But
which was after that CPI report, and then we also got PPI, which kind of kept it going, I guess, on Thursday.
Yeah,
and Thursday, Friday were strong up days. I had talked to you earlier about we had a 90% breadth day. So those breadth thrusts just means 90% of the stock issues, 90% of the companies were positive, and those are historically good things. And then Monday, we also had another 90% day back to back. 90% breadth thrusts are very bullish. But the Monday was a little weaker. It was one of the lowest returning 90% breadth days. I think the S&P 500 was up like 0.63 or 0.65%, something like that. So I don't know. Seemed to be weakening a little bit today as well. So maybe it wasn't your normal 90% breadth thrust.
I don't have an explanation on that point. I would just say that I don't think a day is going to change the overall perception for some of those things that I mentioned. The tariff situation, what it really does is, I mean, they've been very inconsistent on what they're going to do. It doesn't take me to say that. But it makes it very difficult to predict what type of impact it's going to have on the economy. Mm-hmm. And so that's not something that's just going to dissipate in a course of a day or even a week or probably even a month or so.
But that's why I would say a lot of these people that do what we do, I feel like it's a fool's errand to try and forecast and put numbers on paper and come up with a price target right now. Because, one day tariffs are on, the next day they're off. Next day they're 200%. Next day they negotiate and they're off. It's just not a good time to be an analyst, we'll say, and be putting out price targets. I just think it's a fool's errand.
That's what I was getting at last time was the visibility. Yeah. Right. And I kind of likened it to driving down the street in a car, and, on a clear day, blue skies, you're doing 70, 80, depending on where you live, faster, slower. It starts to rain, your visibility dissipates and you slow down. Obviously, makes it a little bit sketchy on the
And,
road.
and we're in a whiteout scenario. You said last time, I think.
Right? Yeah, that's exactly what I said. We're kind of in a whiteout where you can't see too far in front of you, so you've got to slow down so you can see what's going on, what's happening, so you don't hit the next person in front of you or the turn. And I think that's where everybody is. So to your point, I think most people are kind of, I don't want to say giving up on price points, but the visibility just makes it that you have pessimism that wasn't around last year or even at the very beginning of the year. And I don't know that that's going to change quickly.
Yeah. The way I've been thinking about it since the start of the year, and obviously we've talked to a lot of our advisors about it, is, my opinion, my rubbing the crystal ball was first 6 months of the year are going to be tough. We were going to have a lot of change, medicine to take, and a lot of this obfuscation of forecasts because of all these different tariff things coming in and out and the headlines just going crazy. And then the second half of the year, I think we're going to get back into a little bit clearer skies. Maybe Doge will stop their news making items, and maybe we'll start talking about some tax cuts, maybe, or at least continuations. And I think the market will fare a little bit better in the second half of the year.
From your mouth to God's ears, my friend, right? Like, yeah, I mean, this isn't an all bad situation. One of the things that's happening, I mentioned the Mag 7 and kind of the rotation out of growth, but it's going into value. It's going into international. Value is actually up for the year while growth is down 7-8%. Growth is up 1 to 2%, which is something that hasn't happened in a long time. Now, first 3 months of the year doesn't make the year, but people are moving their money from those high tech growth companies to maybe more like your Berkshire Hathaways.
You had shared a very interesting screenshot with me earlier today about, was it Russell 1000 growth versus Russell 1000 value ETF since 2000?
Yeah.
The returns were within 0.1% of each other, I think.
Yeah, I think, yeah, a little.
You would never believe that looking at what tech's done the last 13, 14 years, but wouldn't you know it?
Well, beginning of the 2000s, tech was really bad.
Mm-hmm.
And then after the global financial crisis, it took a few years for tech to come back. Now, the last 11 years, technology has really whomped on value, no question about it. But going back 25 years, they're almost identical.
Yeah. I was very surprised to see that.
Yeah. Yeah. I didn't realize that when I was looking at the data, but it's interesting because you think to yourself, well, why would I own? I've had people say, well, why would I own anything but the Mag 7 or anything?
This year. This is why this year.
That's exactly
why do we
right.
own international, Noah?
Yeah.
This year.
Yeah. And to your point, the EFA, right? Europe, Asia, Far East is up close to 10% for the year.
Mm-hmm.
S&P 500 is down 3.5% for the year. And so these are the times that diversification comes into play. I always say, when you're a diversified investor, or especially as an advisor or portfolio manager, when you're diversified, you're always apologizing for something.
Mm-hmm.
This year or this month, we're apologizing for growth. And
last year it was value.
Last year was value and international. This year, international is leading the way, and we don't have to apologize for it anymore.
We'll see if they continue the outperformance. It's been like 16 years or so U.S. has been outperforming.
Yeah.
There have been small blips, but not to the amount of a full year, I don't think. Could be wrong. There may have been 1 year in there.
There was a year that emerging markets beat domestic, but I think it was 2018 because we were down.
Yeah.
So I mentioned a few of these items on why it's actually going down. I said slightly weaker labor data. We had the jobs report come in on Friday. 151,000 jobs were created, which is actually, it's a little less than expected. I think the expected was 160,000. Still pretty good, but there's
the whisper number was lower though, and that's why the market didn't.
Yeah,
they took it in stride.
Yeah, I think there's a little bit of pessimism out there because we know the government is laying off workers. That's just a fact. They're telling us that that's happened, and that hasn't shown up in the data yet. So,
So next month is the first month they expect that'll roll in, but then we're also seeing court cases and things like that that are saying they can't lay certain people off in certain departments. So this may be a multi-month thing where we see the numbers affected because, as we've said before on here, government jobs were a large contributor over the past several years. Over 50% last year, if you count quasi with healthcare and education.
Let me ask you this then. If jobs contributed, obviously they contributed, but if they were a large part of the growth after COVID, is it acceptable in terms of data to back them out? And then what you have is a scenario where we don't look nearly as good as we do with the government jobs?
I think that's fair, yeah.
I mean, that doesn't make me feel warm and fuzzy on the inside.
I mean, if you look at the numbers last year and divide them by 2 for every month, it's not perfect, but you wouldn't think it was such a stellar labor market if you divide every single jobs number by 2. We did have some very, very hot months, certainly. But if you divide by 2, not so much.
Well, I hope that's not the case. I mean, we still need government jobs, but it seems like the hiring's not going to be so good. If you're looking for a job, if you're a first-time job hunter, I'm not sure you're going to get hired in the government right at the moment.
Yeah.
Maybe in the future. I don't know about today. So we talked about tariff policies, a little bit of slightly weaker labor data. I mentioned slowing disinflation, and you brought up the fact that we had a really good number for CPI recently.
Yeah, we're not at our lows on CPI over the last 6-7 months. But this was our first number where the number went down instead of up in the last 4 CPI figures. So it was nice to see it go down. What was it? 2.8? I have the number here somewhere. 2.8 versus 2.9 expected. Core was 3.1 versus 3.2. So, I mean, 2.8 isn't 2%. They keep saying, that's essentially a hard 2% goal of the Fed, but at least we didn't go into the threes again.
Yeah, we didn't. And the number is, reasonably good. I think the sentiment, though,
we're stalled out a little bit.
Well, stalled out on coming down, right? Stalled out on disinflation. And I'm going to go back to the tariffs again. I think everybody's thinking that these tariffs are going to actually raise prices. And the president and his economic advisors certainly haven't suggested differently. When asked, straightforward, I think they said something about, sometimes we need a little pain. And that doesn't make the market feel good. That doesn't make the investors feel good.
Certainly not. Yeah.
Right. So now we have a situation where the Federal Reserve is looking at the data, and it's really not a cut and dry situation. So last year, before the rate cuts started, the overnight lending rate, which is the rate that the Federal Reserve will lend to the commercial banks at overnight, was about 5.3%. Today, it's about 4.3%. So a full percent down. But there was a much greater expectation last year of continued declines in those interest rates. And I think that helped buoy that return last year for the S&P 500. It's hard to factor in exactly what percentage of the return was based on the expectation of lower rates, but certainly some of it.
That's where you got the multiple expansion. So the price to earnings multiples were getting higher on the hope that we'd have a lower discount rate in the form of, the Fed overnight lending rate.
Yeah. And we're kind of in a no man's land right at the moment.
Yeah. Earnings are going to have to pick up for it. Doesn't look like we're going to get that multiple expansion in the short term. We did start pricing in a couple more rate cuts as, the market turbulence came in here. I saw as high as 3%. It's come off of the highs of that 3% in terms of a percentage likelihood. But it's higher than we were certainly at the start of the year, which was we were getting towards at the end of July. I think we were getting towards only one rate cut being priced in, a little over one rate cut. We do have the Fed Reserve meeting going on tomorrow.
Yeah.
We don't expect a rate cut, certainly, but we are looking for guidance on the path of rates and how they see it. I would expect, due to all the forecasting issues we've already mentioned, that there's going to be a wide range of forecasts because they are going to do their FOMC dot plot, which is each individual member plots where they think rates are going to be on, the forward time frames. And I think there's going to be a wide dispersion. I think the market's really going to look to that, and we'll see the reaction based off that.
How much value do you put in the dot plot? And I mean specifically, over the years, the Federal Reserve themselves, the people that create those expectations for future rates, what they're saying, they've been dead wrong on their own dot plots, Chris.
And they'll cover themselves by saying that is not a forecast. That is with the current data available, that's their best judgment, which sounds like a forecast to me.
Isn't that a forecast?
But what they'll say is it's not an actual forecast.
I mean, they were expecting rates significantly higher for years and years after the global financial crisis, and maybe not like right after, like 10 or 11, 12, but starting in 14, 15, and 16, they were expecting rates to be significantly higher, and they never got there.
Taper tantrums. The market wasn't allowing them to do that, and we didn't have the inflation to really warrant them increasing rates at that time. We were, I don't want to say stagflation, but we didn't get the growth, the GDP growth that they expected would happen, keeping rates on zero. The zero interest rate policies were in large part a dud for several years. It didn't create the growth we expected.
So if they adjust the dot plot and it's lower, significantly lower than it is now, I don't know that they're going to bring it down that much, but if they adjust it lower, and based on recent history, it's been dead wrong.
You're going to fade the Fed?
I'm not personally.
Noah, fade the Fed.
But it just seems like, I mean, to your point about them saying it's not a prediction, well, I mean, kind of is a prediction, and they've been wrong.
Yeah. Yep, they have. I mean, there's been a lot of critiques of Powell. He was about to be the hero, and he did a real good job the last couple of years of communicating. That's his best skill, is his communication. But yeah, I mean, I would argue they've been pretty reactive. And right now they are definitively being reactive, saying we're going to wait and see how the policy shakes out. That's the definition of reactive. Am I wrong?
Saying they're going to wait for data, that's not reactive.
I think they're going to react to the data instead of making a judgment beforehand, making a prediction and trying to counteract that prediction. Seems like they're just sitting on their hands saying, we'll see what happens and we'll react.
Well, I mean, if Powell decides to lower rates and then all of a sudden inflation starts to creep up again, he looks like he doesn't know what he's doing, and they have to raise rates after they lowered. He doesn't want to do that. Mm-hmm. And conversely, like if they see data coming in that supports higher rates, I mean, I don't know that the market would like that, but they don't really take that into consideration. But they don't want to reverse course either way. Right. They've started lower rates, and I think their goal is to genuinely to continue to lower rates when appropriate.
Yeah.
I think the market got ahead on the rate cutting expectations last year. I remember back in,
they were trying to goad the Fed into more rate cuts. Yeah. You know how the market works.
Last year on this podcast, during March and April, we had the regional banking crisis, right? And we had a little bit of a pullback. And I remember saying that best case scenario, we're flat in the markets for a while and let earnings catch up. Mm-hmm. Well, I'm going to say the same thing right now. It's okay for the market to not go up every single year. Our personal expectation and the prediction that we put out was 8 to 14% at the end of the year. But we also called for a significant drawdown of at least 15% in 2025. I'm not saying we're going to get it. We were down 10. We could certainly get more. But I would be just fine if we were flat for the year and earnings continue to grow, so the valuations weren't so stretched. To me, that would be a great scenario.
Mm-hmm.
And I know there's day traders out there and there's people that are hot on NVIDIA and all that stuff that want to see it go to the moon right away. But that's not really how investing works.
I was thinking earlier when you had mentioned how for financial advisors, this isn't necessarily as scary as it is maybe for some clients out there who want to run for the hills. And it's true. It's paradoxical where when you're always at all-time highs, a lot of clients are scared to allocate their money. They'll say, well, we'll wait for a little drawback. But next thing you know, the market's up 15, 20% from that point. And, why were you out of the market? But it's also paradoxical because when the market's down 10%, they're saying, oh, well, I think it could go to 20.
Yeah.
Oh, I think it could go to 30. But I would say when you get down in the 10 to 20% range, people more in our position, advisors and money managers, are free. We feel the option to say it's time to get in. You've had this cash on the sideline. Now's the time to get in. It can go down farther, but this is the opportunity you're looking for.
You're saying use this as a buying opportunity, Chris.
I'm just saying I know many people who got stuck in cash and regretted it. Lots of people.
Yeah.
And this is an opportunity to at least put some of that cash to work. Don't wait to try and call the bottom on a 30 or 40% down market. I don't think that's what we're going to get. But, chances are if we would get to that, you're going to be even more scared then, and you're not going to go in then.
I was surprised. You came to me with a stat earlier on the number of 10% drawdowns, and I was really surprised on how few there were. What was the stat that you shared with me earlier today?
Since 1990, there have been 17 instances of 10% drawdowns. Now, I said at the beginning, they happen on average every 1.6 years. So that math doesn't math. Only 17 instances since 1990. So I get why you push back.
I pushed back right away. I said, no, there's been a lot more than 17.
But that's 17 instances of a 10% drawdown from all-time highs. So there were instances in 2000 where we didn't see another all-time high for years. After, in 2008, we didn't see another all-time high for a couple years. So yes, there's been far more volatility technically than 17 instances of 10%. But that's just 17 instances from an all-time high down. And again, that was the basis of that stat is, on average, the median, it's 85 days till you see a new all-time high. So that seems pretty long. The average is even worse because of those left tail low probability major market meltdown events.
Yeah.
But yeah, and another interesting to add on to that stat, since you brought it up, is when you get a 10% drawdown in those 17 instances, the median max drawdown is only 3.73% from there. That's the case for a good buying opportunity. So if you at any time say, all right, you're down 10%, do you want to buy or not? Your average or median drawdown 3.73%. I would say that's a good risk reward, and I'd buy.
Yeah.
Just trying to be positive, Noah.
You say a good buy. I can remember that when I first started in the 90s, there was an old guy in the office, Mr. Bickle, Russ Bickle. God, he passed away at age 99, coming in the office every day. I might have shared this on here, but I'd run into him and say, "Oh, Mr. Bickle, look at this stock. I think it's a good buy." He would say, he'd look at me and go, "Good buy car, good buy wife, good buy house." And I think what people need to realize is, when you're talking about an individual stock, it can be like that. Mm-hmm. But when you're talking about the market overall, there are a lot of good buying opportunities out there. Yeah. And I would say that down 10% is a good spot to.
You don't have to back up the Brinks truck, but at least apply some cash.
If you have cash on the sidelines, or you've been hiding out for years thinking that you missed the boat, and certainly you have in a lot of cases, just like 2022, the market was down 22% at the bottom from its high on January 2nd or 3rd. I mean, you have to look at down 10% as a spot to deploy capital.
Yeah.
Down 20, even better, but down 10 is a great start.
I'm going to just say this is not a buy on the particular stock by any means, because I think there's a chance, it's going to see more volatility and go down a little bit more. But if you like a Tesla that's down 55%, did you say? If you believe in that story long term, why wouldn't this be a buy opportunity for someone who believes in robots or the AI portion of it? Obviously, car deliveries doesn't get them the valuation they're at. Obviously, it's looking forward to the AI and the Optimus robots and things like that. Again, not recommending a buy, hold, or sell of Tesla. Just saying, it's like those type of drawdowns. If there's a company you believe in the story, you got to take advantage when it's down. If you just, say, oh, I'm going to wait for it to come back, you're never going to get in. It's just people's nature. Like, oh, it's 20% off its lows. Well, I can't get in now. That's basic psychology that we see every day amongst our advisors from their clients, essentially.
I've had incidences in my lifetime of investing where your conviction for a particular company was more emotional than it was based on fact. And it leads you to continue to buy as it goes down, right?
Well, that's dangerous too. Averaging down is not something you want to do, especially if you're a trader. There's a lot of heat on it. Going back to Tesla, there is so much heat on Tesla right now. JP Morgan released a report about how they've never seen a company fall so drastically, and that their quarter deliveries are going to be awful, essentially.
Well, and I didn't want to necessarily talk about Elon today, but I don't think he's doing himself any favors with car buyers.
Yeah.
Things can turn pretty quickly around here.
They went from global to just US, and only half of the US for potential customers.
It does seem like that.
But again, they're not a car company. If you look at their valuation, they're not a car company. They're people. They've always had a tech valuation, and it's for before it was exposure to Elon. Maybe now it's coming back, so it's not for positive exposure. But
I saw a report from a survey, and I don't know the data on it, how many people it was, but it was a survey from Germany that said something like 94% of Germans say today, now, that they will never buy another Tesla. And you're just like, oh man, you did not do yourself any favors, buddy. So yeah, I don't know. It's not a recommendation. I think it's a more, like if you like growth stocks and you like technology.
Yeah, I just use that because it was down 50%.
Yeah.
And if you think that a mega cap will never go to zero, well, maybe you have an option to buy in. Anything can go to zero, though.
I mean, we've seen it happen. You remember Enron?
Yeah. Sheesh.
Yeah, sheesh.
That's right. A can of worms.
Yeah, it is. What else do we have? What do you got? Anything good?
Hey, price of eggs has come down. Finally, everybody's been talking about that for months, and finally, I don't know what happened. I don't have a rhyme or reason to it, but I saw it's down to $4.15 on wholesale, which should, in theory, pass through to us consumers at some point in the next couple weeks or months.
Yeah. I mean, don't you think that those things, just kind of like the baby formula, there was some supply chain issues with the baby formula a year and a half ago. I mean, we had to, I don't know if the right word, put down, cull hundreds of thousands, if not millions of birds from the flu. I mean, don't you think it's just more of a cyclical thing? Like, yeah.
We had the same thing like 2 winters ago.
The birds are in production right now. They're growing at a fast rate. And at some point, everybody's going to be making, producing eggs, and we'll probably have a glut of eggs, right?
Hopefully. And people can't complain anymore.
I would like that to happen.
People love complaining, though.
People do love complaining. I mean, I enjoy complaining sometimes, right? Let's talk about get rich quick schemes for a moment or two. I bring this up. My sister-in-law and I were out on Friday with my wife. We were at dinner, drinks, cocktails, and she tells me this story, and every bit of this story gets worse and worse and worse. So she works for a large bank that everybody would know. And earlier in the week, there was a gentleman that came in who wanted to do a Fed funds wire, meaning take money out of his account and send it to somewhere else. And, it was a pretty large dollar amount. It was something like $200,000. And so there's a fair amount of security that goes into that, and asking him what it's for, and trying to be responsible to prevent fraud and theft and things like that. And he said that he's a farmer. That's kind of a known quantity in this scenario. He's a farmer, has a small farmette outside of Philadelphia, and he was going to be sending the $200,000 to a company called Uline, which is a supply company. I mean, make anything from trash cans to boxes to
fully legit company.
Yeah, fully legit company. He was going to be sending $200,000 there, and so they go through the process. And they take all the information, and he had this whole background story about why he was doing it and what he was purchasing from the company, and they proceed to process it. Now, apparently, that takes a little bit longer for a large wire like that, and you have to go through extra security details. But eventually, they get it out. They send it, and or shortly after that they've sent this Fedwire out, they happen to look at the email on, I don't know if it was the back of the paper or something like that, but someone spots an email and it was like rebecca.uline@gmail.com. And all the alarm bells started going off. And my sister-in-law, Kirsty, is the branch manager for the bank. And so they go into reaction mode and they call their fraud department and they start pumping the brakes. I don't know if I'm pretty sure it left regardless. So they wind up getting on the phone and talking to the client, and he's telling them, that this is okay. There's no problem. And I guess at some point in this conversation, she says, well, I want you to know I've called Uline, and the Fed funds wire information that you provided to us, they said that is not the wire information. And then I see this email and it has the name Rebecca on it. And he interjects, he cuts off and he says, don't bring her into this. And wow, the plot thickens. So apparently this person has been in some type of online romance scam with an unknown scammer. So I'm not too familiar with this, but apparently this is a big thing that's happening. And people out there may have gotten on their cell phones unsolicited texts that asked, hey, I haven't seen you for a while, or hey, who's this? I got a new phone. And the whole object here is, building trust with somebody and then extracting a large dollar amount of money from them, right? So they go through this whole build trust and rapport. And in this case, I think they're going to find out that it was some type of romance scam, right? It could be some random guy.
He's just looking for love, Noah.
He was just looking for love. But what I've seen now that I've looked into this a little bit is that a lot of these romance scams start as a romance situation, and then they go into, they eventually ask, well, what do you do for a living? And the fraudster says, well, I make a lot of money on cryptocurrency. And so in some cases, I'm not saying in this case, I don't think we know yet, but in some cases, they create online profiles of the currency exchange or the cryptocurrency exchange, and they say it's really easy money and this is how you do it. But they don't want other people to know that you're going to do it, because as soon as you tell somebody that you're going to send $200,000,
was this to an international bank, or?
I don't know that they knew. They just had a wire number. I'll get those details. And so I bring it up because in our industry, we have a lot of people with a lot of money that do invest, and we have a lot of people looking to extract those money in a fraudulent way. The famous bank robber, Willie Sutton, he was asked, why do you rob banks? And he said, well, that's where the money is. And so you have these fraudsters out there that are sending out hundreds of thousands, maybe millions of texts every year. And they just need a few people that have money to be able to go through this scenario. And the fraudsters are definitely exploiting the emotional side of this. Mm-hmm. And so I bring this up because I want everybody out there that's listening to know that there's no legitimate reason that you should be sending money to somebody that you haven't met, or to some crypto exchange that you've never heard of, even if it has a profile online.
Yeah.
Right. So we can get into the whole thing about identity theft and fraud, but this seems to be a growing situation. I mean, we have people, I'm sure you've probably got it, you get a text that says, you owe money from the toll booth, right?
Yeah,
Here in Pennsylvania, right?
And I get the spam calls and I don't even answer because I'm scared they're trying to take my voice and like do something with it, because my personal brokerage account, they know when you set it up, they say, do you want to do voice ID? It's like, I say no, but some people say yes. So some people are trying to take your voice when you answer the phone. With all the AI available now, they just need a few words.
Yeah. It's scary.
Yeah.
It's scary. So like I said, for anybody listening out there, these fraudsters prey on emotion. Please don't feed into it. Don't send anybody money. Don't start a dialogue with somebody that unsolicited. And I don't mean like on a dating site. I mean, if someone texts you, hey, how are you? And you're like, I don't know this number. And you go back and forth. It's a scam. It's fraud. Don't do it. Don't engage. It's not going to end well for you. Yeah. And Kirst, thank you for telling me the story so I can make sure everybody out there knows not to do this. And hopefully we'll figure out more information. I hope the guy wasn't married. That's all I got to say, because I don't know that it's going to.
If he already had love, there's no excuse for that. And maybe that was karma coming for him if he was married.
We'll have to. Inquiring minds want to know. Inquiring minds want to know. You have anything else for the good of the order?
Nope. Okay. I would say just enjoy the ride in the market. And if you feel so inclined, talk to your advisor and see if it's a good time to put some money to work.
Yeah. Be opportunistic. Thanks for listening, everybody. We appreciate it. Questions, comments, or concerns, send us an email at marketenthusiast@goodlifefa.com. Love to take your feedback, and we'll put it out here next time if you do. Thanks so much. We'll see you soon.
The opinions voiced in this podcast are for general information only and are not intended to provide specific advice or recommendations for any individual. To determine which strategies or investments may be suitable for you, consult the appropriate qualified professional prior to making a decision. Economic forecasts set forth may not develop as predicted, and there can be no guarantee that strategies promoted will be successful. All performance referenced is historical and is no guarantee of future results. All indices are unmanaged and may not be invested into directly.